Thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the Q&A window. The Mercer team and ourselves will address these after the presentation during the Q&A portion of the webinar. If we don't get to your questions during the session, we will follow up with you after the webinar. The webinar is being recorded and the link will be added to the fftc.org website. You can access it by going to menu and the link is under Engage, Events and Webinars. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. We also have a special guest today, which they will introduce later. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the third quarter of 2025. And I'll hand it over to you. Thank you.
Great. Thanks, Natalie. And hi, everyone. Welcome back. If you've joined us previously, and welcome if this is your first time. Really appreciate you spending some time with us this afternoon. Both Tim and I are here today. Tim and I have worked together on your relationship for about 8 years. And it's been our honor to do so, and we love doing these quarterly updates. As Natalie noted, joining us today from our alternatives team is Kenny Pittman, based in our Denver office. Kenny's going to spend some time talking about private equity. You've gotten some really great questions, and so we are hoping to address some of those as we go through. But as we often do, let's start with the agenda, and we will start with a brief market overview, give you a sense of the current markets and what we're thinking about the world going forward. We will then dive a little bit deeper into private equity investing, exploring things like the opportunity set, where we go from here, return expectations, and the like. And then we'll go through the standard pool performance. And then, of course, we will take questions from you. So hopefully you will have some good ones and tough ones for us today, because we'd certainly love to hear from you. So with the markets, it's been really pretty darn good. We have seen really from the lows set about a week after April 2nd, we have seen the market take a completely risk-on stance. Equity markets pretty much across the board are positive, but narrow leadership has been narrow as it has been at multiple points of time over the last, call it 5 or 6 years. So global equity markets were up about 7.5% through the third quarter of the calendar year. U.S. equities were strong at up a little bit more than 8%, but you can see two subgroups of the U.S. marketplace really led performance. U.S. growth, which is the broad U.S. Stock market from a growth style perspective, up a little better than 10, driven by the names that you know and love, the Magnificent Seven, or the companies like Microsoft, Nvidia, and the like. Those companies have continued to drive the broader marketplace. The AI story is alive and well in public markets, and we've definitely seen that drive results since really the bottom of the bottom point of early April. You see the small cap numbers are really pretty strong as well, up 12.5%. That is relatively narrow leadership as well. Companies that are more speculative in nature, maybe they have much more, I don't want to get too many fancy words, but basically very high expectations around growth long term. Maybe not so strong of company fundamentals in the near term. Those kinds of stocks have performed extraordinarily well as investors really have taken on this risk-on exposure. Part of that was driven by the potential for lower interest rates, and we'll talk more about that in a minute. But really, pretty much across the board in the U.S., we saw strong results led by growth and by smaller cap companies. Non-U.S. also performed really pretty well. Developed markets had a stronger first half of the year, not quite as strong in developed markets in the third quarter, but we saw emerging markets really pop and come back, and a portion of that was led by a resurgence in China. So owning equity has continued to be a great place to be if you're trying to maximize returns, but definitely with much more of a bent towards more speculative parts of the marketplace. Rates did fall. We have seen Fed action this year as the Fed's cut rates twice. That allowed core bonds to be up about 2% in the third quarter. Longer term treasuries up about 2.5%. So not rather tame returns relative to the equities, but really pretty solid returns for fixed income given yields where they still sit. The 10-year Treasury still today sits just a bit north of 4%. And so all things being equal, we're getting really pretty solid fixed income results, uh, after about 15 years of zero interest rates. For the trailing 1 year period, it's really the same drivers. You can see pretty fantastic results for global equities in general, up a little better than 17%. Still, again, led by those big growthy names, those big magnificent seven names at the top of the index. You can see the smaller cap results, while still strong at nearly 11% over the trailing 1 year period. Not quite as ebullient as the rest of the marketplace, and more of that 10% has come more recently than at the beginning part of that stream. And then again, over the course of the full 12-month period, core bonds in the US just up about 3%. So some participation, but really all the action has been in public market equities. I just wanted to hit a couple other things, and these might be kind of small, so I'll apologize. But I just wanted to hit a couple other notions here. Higher beta and higher momentum stocks. That is stocks. There's a factor in the marketplace labeled momentum, and it essentially says that if it's been working, there's a higher probability that it will keep working. Uh, I'm sure you all know what momentum went, but it's a simple technical definition for equity markets, and momentum has been strong. So what that suggests is that investors have locked on to some themes and have continued to buy them. And we see that right up through really the end of October. Just in the last couple of days, you're hearing some noise in the marketplace as some of these themes may be a bit stretched. There's more to be seen on that, but you can certainly see that over the last year, relative to the U.S. stock market, momentum and growth have been the only two factors to generate excess returns versus the broader index. And so that provides us with some information value when we look at the active management of our implementation, particularly in U.S. equity. It has been a tough road to hoe, in part because this of this very narrow leadership in terms of factor exposure. So I wanted to give you a highlight there, just give you a different kind of flavor of that. And then the notion of particularly the impact of interest rates on smaller cap stocks. You can see the Russell 2000 value and the Russell 2000 growth. So these are small companies in the US with a growth or value tilt. Pretty similar returns over the quarterly period. And in large part, we think because of this expectation for lower interest rates. These companies tend to have higher debt loads. Debt tends to play a bigger role in the management of their business. And so all things being equal, lower cost of financing will be positive for those stocks. And we think you see a fair amount of that just across small caps in general. And again, in part because we saw that pop in the value index in addition to the growth names. So there was a Federal Reserve meeting in October, and there's a lot on this slide, so I'll click through it relatively quickly. But we just want to give you a sense of where the interest rate environment is and where maybe think it's going. So, as expected, the Fed cut 25 basis points to the Fed fund rate, took it down to a range of 3.75 to 4%. So that's second cut of the year. And it is the lowest rate in 3 years for overnight rates. And overnight rates, they primarily impact things like small consumer loans like credit cards, as well as revolving corporate debt, and things like car loans. Not so much these kinds of rates tend to have less impact on things like home mortgages. It's more around the 10-year part of the curve. But the Fed has been active, and they're trying to balance the notion of inflation in full employment. So as most of you know, the Fed has two primary mandates, managing inflation and managing for full employment. And so while inflation is not fully retreated to pre-pandemic levels, it has improved quite a bit, but there has been growing concern about the labor market in the US. And so that's why you've seen the Fed active. What was the reaction to this? Treasury sold off a bit to get back up above 4% and rather quickly. And so this suggests that the bond market is thinking that inflation is not whipped and that there may be some remaining inflation in the general economy in the US. And so as a result, investors investing in a 10-year bond need better protection against erosion of purchasing power for that 10-year investment. And so 10 years stayed above 4 more or less since this rate cut came in place. I think it will be interesting to watch the data and the rhetoric out of the Fed uh, in the coming months as we get closer to the December rate cut to see what the ramifications are. Equities, there's a lot of noise around the market. Equities rallied at the start of the day. They jumped around. Equities were really pretty strong until the last couple of days. So I don't know that the Fed action is really driving short-term equity performance right now. And then the dollar was up a little bit. As we talked about in the last webinar, the dollar has weakened versus non-US currencies for the first time in a long time for most of this year. And that's helped our diversification in our non-US investments. Dollar popped a little bit on this news, but by and large, it has been flattish. When we look at the impact or some of the highlights around the dialogue, we are seeing now, perhaps different than Feds of old, more dissension. So this is the second vote in a row where we've had two dissenters. One of the dissenters is the same. The other dissenter is new. But what's interesting is how far what their dissents were. So Governor Miron, who's the newest Fed governor and has been publicly on record in favor of much greater rate cuts, dissented in favor of 50 basis point cut. Kansas City Fed President Schmidt actually voted in favor of no change. And so that's an interesting spread of ideas. We are starting to see in the dot plots, which are an estimate of where Fed governors believe rates will be over the coming months, more dispersion in those dots than perhaps we've seen in the past. And in some ways, I personally think that might be a good thing. That means we're not just running on autopilot. We're not just bowing to the whim of one or two voices, and that we're actually getting a robust debate that hopefully then leads to better decisions and better outcomes for everybody. But we are seeing more diversion. And then we're seeing the inflation picture start to evolve a bit. There are still issues with goods prices. There are still issues, some of which are related to the tariffs, but we're seeing other parts of the inflation curve maybe start to back off. I'll click both of those because you won't be able to read them anyway. I think one of the key notions coming out of this was just this concept that Powell noted that a December rate cut is not a foregone conclusion. And that's, we think, a key statement. Pretty direct, pretty emphatic in his statement that don't get too ahead of yourself. Well, they may still cut. There may still be plenty of data points by then to cut, but recall that the government is shut down. They don't have all the data that they would normally have. And so it might appear that they could be cautious going into December and even maybe wait until they have better data instead of continuing this cutting regime. So I think will be definitely something for us to keep an eye on as we move through the holiday season.
Travis, I have a question. I've seen a lot of headlines recently about large companies cutting or laying off a good amount of folks. Is that just headlines right now? Do you think it's an overall broader indication of labor market that's just not coming up in maybe the ADP reports yet? Or just what's your thoughts around that?
So they're pretty sizable numbers. I haven't spent a ton of the time of the data yet, but my anecdotal view is they look like they're a bit more white collar. In a lot of cases, you're seeing more white collar type businesses they're seeing layoffs. Some of this could be, if you will, pent up trimming. So if you recall, coming out of the pandemic, because it was so hard to rebuild employment roles after laying people off or furloughing people, that businesses in general maybe held employees longer than they might have through the regular part of the cycle because it was so hard to get them back, right, if they absolutely needed them. And so thinking now, I saw an interesting headline that outside of the Mag 7 earnings estimates for basically most of the S&P besides the Mag 7 are actually coming down, which suggests that company managements are going to start thinking about margins and margin compression and expenses and what can they do to control that while they also still kind of try to grow. And so I think you could be seeing some of that in this environment as corporations start to rationalize their cost structures and decide, do they have the right cost structure to deliver the earnings that their investors expect? I think it's still too early to tell if that is a big trend and whether that ultimately leads to much higher layoffs. Uh, there's a lot of moving parts in the employment market right now. With the reduction in immigration, there are estimates now amongst market pundits that we might only need 50,000 jobs a month to stay even, uh, which to most
Speaking of
people
that,
feels like,
I just pulled up the Wall Street Journal and ADP just came out, said US private sector added 42,000 jobs in October. So
right.
it's about
So
50.
yeah, so about 50. So we might be, and so for us of a certain age, that's going to feel weird and broken and wrong, uh, because we're used to 150 being light and north of 200 being much better, right? So I think it's a little early to tell what the impact is going to be, but I think if corporate managements maintain the views that corporate managements have now for a generation, is they're going to continue to try and optimize their expenses. To drive earnings growth while not sacrificing revenue growth. And then I think it remains to be seen the impact of efficiency tools like AI. Every company in America is looking for a way to get leverage and um, efficiency out of AI. And I suspect that it's certainly the rhetoric coming out of some of these companies is they're being successful in doing that. Uh, Microsoft, I think, actually came out recently and cut a decent swath of employees in part because they've made great strides in the implementation of their AI agents. So I think we could see more of that. And I think that will be interesting to watch. Clearly, the more layoffs you get from efficiencies by those companies, the harder it becomes on the economy because again, 70% of the economy is driven by US economy is driven by the consumer. So to the extent the consumer can't spend, and particularly white collar jobs where perhaps they're at the upper end of the economic spectrum, where those folks are more likely to spend and can spend versus at the bottom end of the spectrum where lower income folks are much more squeezed by higher food and energy prices. Could be really an interesting dynamic to see how investment markets start to digest that. So great question. Hopefully good answer. Lots of moving parts there to go along with that. So appreciate the question.
Hey,
So with
Travis,
that,
if you don't
oh yeah,
mind,
go
I'll
ahead,
just
Stephen.
jump in here. Hey, everyone, Stephen from the investment team at the foundation. So, um, if you've noticed the past, I think we started 3 or 4 webinars ago. We've tried to, pick a theme that's going on in the markets that a lot of our donors, I think, are thinking about. And that's really impacting investors. We've done international versus U.S. stocks. I think we've done active versus passive. We had a great donor question around privates in general. I think the question was really two-sided, one being, are there too many dollars chasing too few opportunities in privates? And, kind of what are these companies paying for the underlying investments? And how's that going to play out? And then secondly, I know, Bobby, Natalie, and I have been to conferences lately, and everyone's talking about private equity getting into 401k plans and retail investors. So I know you have some great slides here with Kenny to cover. I'm sure you'll hit on both of those topics. We just want to say thanks for the questions to all of our donors and keep them coming and we'll take your feedback. Thanks, Travis.
Excellent. Thanks, Stephen. And thanks also to the donor group that had the questions. Those are great. Those are very timely. Kenny will hit on some of that as he talks about the opportunity step. But maybe without further ado, Kenny, I'll hand it over to you and we'll try to align our clicks.
Cool, Travis. And thank you for the introduction. Thank you, everyone, for having me on. Thank you for the questions, too. Quite candidly, your questions help us help manage your portfolio better. So please keep them coming. We want to understand what people want to see, hear, and think about. And we understand the private equity is a wildly complex topic that requires education. We're happy to be here for anybody that needs it. Travis, if you don't mind, I'm a simple man, so if you don't mind clicking through just to get me on the full slide rather than the individual clicks, we're good to go. My name is Kenny Pittman. I, alongside a partner, lead Mercer's alternative investment business in the United States out of Denver, Colorado, originally from the East Coast, from Boston, Massachusetts. And I do spend a fair amount of time in Charlotte. It's a beautiful city, wonderful place, wonderful state. So thank you for all the support of everything we do, and hopefully that's reciprocal. Stephen, questions noted. I saw them in advance, so I do have good responses, and I'd be happy to discuss live as well. I do think it would be helpful to level set, though. We do see a ton of headlines around private equity. It is admittedly a relatively opaque topic and a relatively opaque space unless you have a good advisor that can help you. And anytime you have that opaqueness with a lot of questions, you get a lot of theories maybe presenting themselves as facts. So I just wanted to take a step back, talk about what private equity is, talk about why we think it's beneficial for people, and then we can kind of talk about what's happening today. And again, many, many headlines about private equity. Couple of very broad statements to make. One, at a base level, private equity is exactly what it says it is. It is owning equity in companies on a privately transacted basis. So that usually means rather than buying stocks or bonds that are traded in the New York Stock Exchange or another centralized location, you are just buying private businesses, right? Now, how you buy those businesses is wildly different with fund structures and how the transactions operate. But at a base level, it is equity in a company, the same way stocks are equity in a company. And I think that's meaningful. And I think that's really important just to level set with people. The other piece I will say, it is a highly, highly heterogeneous opportunity set. And we'll talk about that in a minute. But private equity is not one thing. In the middle of this page, you're seeing kind of the big buckets of private equity strategies that we see. But on a sector basis, on an industry basis, on a growth versus value, on a venture versus buyout, it is a very, very heterogeneous space. We think that's helpful. The base principle that we believe private equity adds to portfolios is one, is it is a return driver. Now I'm going to say there are 2 points to that return driver. One, we think there is just an elevated premium you receive for owning smaller businesses and being a liquidity provider to those businesses. And then you have the aspect of active management and operational expertise that we do believe compounds that, but we don't think the active management piece is the only reason to buy private equity, and that's important. The other piece is private equity is generally return oriented reason to add to your portfolio, but it does help diversify your equity book as well. Right now in public markets, you have 4 or 5 companies that are driving the entire artificial intelligence narrative. We know that artificial intelligence is going to change the world, but nobody is quite sure how, what, when, or where, right? And through private markets, you can diversify a lot of those bets into things like artificial intelligence. And again, we think that's really important. And again, just kind of putting some proof points to what I had mentioned. You will hear about private equity. You will hear about venture capital. You will hear about growth equity. You will hear about buyout. You will hear about special situations. Those are all just heterogeneous versions of private equity. And we think a diversified portfolio needs to include most, if not all of these, right? And you're seeing how those strategies align with maybe a slightly more understandable graphic of the life cycle of a company, right? Venture capital is a proof statement. Venture capital is, I have a great idea. I need some money to go figure out how to sell that great idea. Highly risky, not necessarily cash flow oriented, but if you capture one of those great ideas, it is wildly transformative for your portfolio and your constituents and the foundation in general, because that is the area you can find a 10, 20, 30x. And if you allocate the right way, you can continue to harness those numbers. Growth equity is the back end of venture capital. It is largely, I have an idea. I need money to fund that idea. Now we're at, I have found that idea. I have sold that idea to people. I need money to build my operation so I can sell that idea to more people. So again, technology oriented typically, and historically that is changing a little bit, but it's more so focused on scale capital and providing people access to things like sales resources rather than idea generation and venture capital. And there's a different risk profile associated with that, but you can still find some of those outside returns in growth equity. Buyout starts to become a wildly different game. And buyouts is very much so a cash flow oriented game. It is buying paving companies. It is buying local small businesses. It is buying business services companies that largely are interacting across our economy in the United States. And again, that is a cash positive business. Those are companies that are making and compounding dollars every year. And a lot of stability comes from that, a lot of earnings. Again, it offers a very kind of different risk profile. Then toward the back end, a company does too well, it gets a little bit too happy, gets a little bit lazy, needs some refreshing. That's where you begin to see special situations. So I probably spent a little bit too long on this slide, but I just wanted to put some real world terms behind some of the things that you guys all hear about in the newspaper. And Travis, if you're okay, we can flip over and add to a bit to our proof statements here. So, there have been a lot of questions around private equity over recent years. We also have seen outperformance in public equities, and we'll talk about that in a minute. But we don't believe that totally absolves the need for private equity. Again, we believe that private equity will be a part of our economy. America has been built on small business. It will continue to be in our mind. And we think that a lot of these numbers kind of demonstrate that. So there is a lot of talk about investor portfolios and liquidity and private public equity and all this stuff. But the base point is that you are missing a huge opportunity set if you only allocate to public equities. And a lot of the data on this page is showing that. So one, you don't have to look at the individual charts. There are over 120,000 private businesses in the United States. Many of those are family-owned businesses. Many of those are looking for generational change. That is an opportunity to allocate to businesses that need capital, that interact with us on a daily basis, and quite honestly are a little bit more understandable in many cases than those conglomerates that we invest in public markets. They're, again, the local paving company, the local payroll services company. A lot of the service providers may be to FFTC. It's not this nascent thing that might be positioned in some way. When we do talk about private equity, it's always helpful to remind everyone, I mentioned the number of private businesses available in the United States. You compound that to public businesses, and we're somewhere in the 3,000 to 5,000 range. There are far more private businesses in the United States, but those public businesses still do hold a good chunk of GDP, but it's not everything. They are larger businesses, but public or private businesses add a material amount to our economy. And that's what you're seeing in the middle. You're seeing basically GDP contributions across a couple different lenses. And what you're seeing is that small private businesses add about a third to a half of GDP within our country every year. You're missing a massive opportunity set to interact with our economy by not allocating to private businesses. And then finally, large businesses versus public businesses. What we are seeing, and Travis, you can flip to the previous page because it's the same proof point there too. We are seeing companies choose to stay private longer. And we think that's occurring for a few reasons. So one, on the left side of this page, you're just seeing the numbers, the growth in private businesses relative to kind of the flatlining of public businesses. The honest truth is that public corporate governance is challenging for a growing company. Travis, Tim, and I all work for a public company. We have 4 to 5 different business lines. There's a lot of stability that comes with that. There's a lot of transparency. There's a lot of forecasting that we can do for our investors in MMC, right? And that's what public investors want. They don't want to hear that we have to go invest $100 million to try to build a new business. But that is the reality of a lot of the great ideas that are coming through our ecosystem. And we think that private ownership owned by people that can take that risk is appropriate. And again, foundations that have a perpetual time frame, as long as it's sized appropriately, we think are the appropriate ones to take that risk and be rewarded for that risk. And you're seeing where that's changing. So more companies are staying private longer. Then if you think about the change to our world that's happening within technology, again, you do get a fair amount of exposure to that through the big names you see in public markets. But the democratization of those ideas, the small startups that are driving the AI ecosystem, a lot of those are staying private longer, and they're becoming really large companies in the private marketplace. So the middle chart is showing the number of private equity unicorns. That can be defined a few different ways. Think about it as someone that's made 10x on their money, or maybe a certain market capitalization that's grown as a growth multiple. It means that they are a scale of large business. They are choosing to stay private in their governance structures rather than kind of IPO. Now that can be impacted by public market conditions in some ways, and you did see that on the right chart. But from the early 90s through now, you're seeing a pretty consistent trend with tech companies staying in private governance and private ownership structures longer. And again, we think it's really, really important to maintain access there. Travis, we can flip. A lot of this next slide will just be a summary of what I've talked about. Again, public markets have had a great run past couple of years. Quite candidly, the data that we're seeing over the 1 and the 5 year numbers, private or public markets, so think S&P 500 or MSCI World, are beating private equity numbers. The markets do beat to the 2 different drummers, right? So that can actually help the portfolio, having some diversification and timing there. But the more important comment I have is that over the long term, from the data we have, private equity ownership is still adding a ton of value relative to liquids in the portfolio. And you're seeing that in the 10, 15, and 20-year numbers alongside the left side of that page. Again, what we're doing is comparing IRR on private market strategies relative to a public market equivalent using the MSCI World Total Return Index. You're seeing 300 to 500 basis points in outperformance across those long-term numbers. And again, that spread that I just cited, 300 to 500 basis points, that might change through time, and it might get sideways over shorter periods of time. But Mercer believes that will continue so long that we continue to allocate capital effectively. And the big thing on continuing to allocate capital effectively is that the private equity market had been nascent for a long time, meaning there are a lot of opportunities. There are opportunities for financial engineering, just buying a business, levering it up, maybe laying people off, and then selling that business. You make money by doing that. There's no way to make money doing that anymore. The private equity managers that we allocate to and the ones that are really kind of driving this market, they are executing on operational change. So that means buying a business, working with employees and ownership of that business to drive strategy and change that will enable organic growth. And then they will sell that business once they've executed on that value creation strategy. And we think that's a huge change. We think that's valuable to the economy. We think it makes the economy more efficient. And we think it will enable private equity managers to continue driving value within their portfolio companies. So that's the setup. If we flip over, we can talk about here where we are now. Again, I'm not going to bore you with a number of charts. I'm going to kind of get to the point here. We are seeing initial signs of green shoots in private markets. We've seen liquidity easing up a bit. We are seeing quality assets trade. But that is balanced with the fact that we are at a moment where geopolitical and economic uncertainty is elevated, right? And how those two factors interact, I can't tell you. Anyone that tells you they can tell you, they're lying to you, so don't listen to them. But the fact remains is that we are at this moment in time where it pays to be diversified, it pays to be cautious, and pays to think through what you do. But that doesn't mean totally ignoring private equity. It impacts how you allocate to private equity and maybe your size in private equity, but we don't think it's a reason not to allocate. If we scroll down again, and Travis, not for you to scroll down, just everyone's eyes scroll down. Artificial intelligence has hit everyone in the face over the past 2 years. It's impacting public markets. It's impacting private markets. It is having a huge impact, one on the growth and growth equity and venture capital ecosystems, but even more so in the buyout ecosystem. Companies are having to adapt to using artificial intelligence, and private equity sponsors that can use that as one of their operational ads can add a ton of value to the companies they own. And we think you get a fair amount of exposure to that change in that value creation through private markets, and we think it's important. And then finally, this does tie to one of the questions that was asked, democratization of alternative investments in general. We saw private assets making their way into, we've been allocating to private assets for family offices and extremely large individual investors for many, many years. But you have been kind of seeing that creep down to lower and lower thresholds. And we are at a moment now where you can find private investments for anyone with $1 million in liquid net worth. And we're looking at a moment where maybe they're going to be added to DC plans. That will change the market, but we don't believe that it will entirely, again, eliminate the market or make it not available for opportunity. So if we flip over, we're going to talk about how we're adapting to what we're seeing. So one thing, slower exits, and if the geopolitical factor on point one takes over, slower exits and additional illiquidity in this market does present opportunity. We're seeing huge opportunities in things like GP continuation vehicles, things like co-investments that can enable people to take advantage of some of the illiquidity if it does persist. On the other side, if the positivity that we're seeing in the private markets persists over some of the geopolitical risk, we're going to start seeing exits and we're going to start seeing the market pick up. And we think that's going to be really, really helpful. So we're spending a lot of time trying to position ourselves to benefit from continued illiquidity if it occurs. And we think if the market opens up, that's really going to be rewarded. We're spending a lot of time. I had already showed my cards a little bit about artificial intelligence. Everyone is talking about artificial intelligence. Whenever you hear the word Microsoft, it usually comes up. Whenever you hear the word venture capital, it comes up as well. That is not the only place where artificial intelligence is having an impact. It is having an impact on most businesses. It's having an impact across our business. It is having an impact across our world, and how people adapt to that change is going to be wildly, wildly important in the future. But there is uncertainty there as well, and you need to be diversified, and you need to be careful, and you need to make sure you're harnessing that trend, but not placing too many thin kind of bets. And then finally, democratization. If more people are chasing the same amount of opportunities, the return premium for that opportunity will come down. Now, I had already argued earlier that we think the amount of opportunities in private markets over the long term has and will continue to increase. We have seen a slowdown in that over the past couple of years, but we don't think that's a fundamental change. So on one hand, we are seeing capital rise to the moment to take advantage of increasing opportunities. But we also know the investment management industry, and we tend to get very excited about trends that the industry can make money on. And you need to be really careful in how we are adapting to that change, particularly with defined contribution plans and things like that. And that's what we're thinking about in our broader business. Manager diligence and asset allocation is becoming increasingly important. How that pertains to someone that is allocated to private equity now is that you are correct. Things like secondary markets or maybe the ultra large cap buyout space, that's where individual investors and that's where these DC plans are tending to allocate to private assets. The return profile probably will be lower than those, and that also might be justified, driven by their risk profile. It's usually a more mature exposure, more diversified, more supported. Not necessarily a bad thing. It's just a new bucket. But for you folks who have been allocating to middle market private equity, quite honestly, if you see a huge bump in demand, you will see elevated valuations in the mega cap market. Most of your managers, the middle cap managers, they're going to be selling into that market. Could be a good thing. You're selling into elevated valuations, selling into higher multiples. So again, I'm not a fortune teller. I cannot tell you where things are going to go. But I can tell you that private equity has been a huge piece of our economy through time. We do believe it will continue to be a huge piece of our economy through time. We think a continued allocation to private assets helps long-term investors. You just have to be very thoughtful in how you do that. And Travis, with that, I am done. I'm happy to take any questions, but very relieved to get off my soapbox unless I missed anything.
Super. That's great, Kenny. Really appreciate the comments and taking us through that section. I think I will just add before I move on to the standard pool performance, just in relation to the FFTC portfolios, and the more specific questions that we received. We do continue to allocate to private equity, but along lines of Kenny's themes, very important is manager selection. So we want to work with managers that are driven primarily by getting good deals done at good values, at good opportunities for them to create value rather than getting dollars deployed. And so while we will commit regularly, we're committing to managers that are diligent with their capital. I can think of a couple of managers in our stable that they raised funds in 2022, and they're only just now starting to actually call capital as they're finding deals that are applicable. So that's part of how we help. That's part of how we seek to manage our exposures over time, because we want to be very sensitive to the market, the opportunities that are available, and the best way for us to do that is to work with really strong managers that can hopefully give us that view. So manager selection is going to be important. Continued diversification, to Kenny's point, is going to be important. So diversifying across client types, across vintage years, across deal types, across vintage years, making sure that we have a robust structure so that we can take advantage of the opportunities as they come. It is very hard to time a 10, 12, 15-year investment. And so those are a couple of key items I just wanted to reinforce before we close out this section. So Natalie or Stephen, any questions from you before we tackle performance?
We actually have a question from
we do. Oh, great.
From one of the
and a phenomenal question, by the way,
Yes.
too. There were two parts. I can answer the first part. Travis, Natalie, do you want to just talk a little bit about what's currently in the portfolio by way of private debt?
Yes. Travis, I'll let you take that. So the question is, do you consider private credit as part of the private equity allocation or part of the fixed income allocation?
I'll take that first part, Natalie, once you guys are done too.
Yeah.
Cool.
So so in terms of private credit, we do have a distinct private credit target allocation within the diversified long-term growth portfolio. It's a 5% allocation. That's alongside a 5% allocation to private real assets, which would include things like real estate or infrastructure. And then a 15% allocation target to private equity and all those underlying flavors of private equity that Kenny talked about. So we manage private credit as a standalone entity, if you will. We think of it more so today in lieu of what we might invest in fixed income dollars. So it's not your grandfather's fixed income. It's not core bonds, investment grade bonds. So doesn't have exactly the same risk profile, but it's not exactly equity either. So it sits sort of in the middle. We think it adds value over the long term to generate a nice income-oriented return. Because it is credit, much of the return within credit is still driven by the income that comes off of that debt. And we like that notion as a diversifying feature. much of what we think about in terms of return today is really this notion of capital appreciation, but capital appreciation doesn't always work. And so having a component like private credit in the portfolio at higher yielding rates, perhaps than investment grade credit, we think is a really nice diversifier and a nice way to reach for in a risk controlled way, reach for some additional returns over time.
And just adding some context to what Travis had said, historically, let's call it pre-Great Financial Crisis, people did view private credit as part of the private equity opportunity set, but we saw a massive change during and after the financial crisis with banks exiting the lending markets. And historically, the reason private debt was included as part of the private equity opportunity set was because most of it was capital appreciation oriented. It was maybe taking control of the business through debt. It was maybe lending with some warrants or some pref on top of it that resembled equity types of returns. What we have seen following the Great Financial Crisis is people are going to private capital markets for straight line loans. Now it's generally, credits that resemble the credit quality of a high yield bond or a bank loan that are doing that. So you do have to size it appropriate. Private credit is not like a treasury, but it is far more like a high yield bond or a bank loan, which sits in kind of an opportunistic credit bucket than it would sit in private equity. And if you do invest in private credit, expecting private equity like returns, short of a couple of very specific strategies, you will probably be disappointed. So we think it fits in the credit and the fixed income bucket as a small component, as a return enhancing component of that specific piece of the portfolio. But ultimately, the same way equity is equity, credit is credit.
Excellent. Thanks, Kenny. And great question. Thank you for that. Okay, let's move forward and run through standard pool performance. It's been overall results have really been pretty good, so I will be brief in my comments today, but all the standard pools were positive and what was a very strong positive quarter for asset classes across the board, as we talked about. You can see our lowest risk strategies in terms of the liquid reserves, which is cash, low duration fixed income, and the income and growth, which is, as a reminder, is 60% fixed income. All three of those really generating pretty solid returns for the quarter. When we look at our longer term pools, the passive long-term growth through diversified long-term growth, you can definitely get the feel for or the sense of the strong equity allocations. As a reminder, passive long-term growth, active long-term growth, and the ESG long-term growth are all 75% public equity. And so standing in strong place from a market perspective to participate in returns. We see the passive performing just a little bit better than the others. The active long-term growth for the quarter, but are both still really pretty competitive, driven by some of those factors that we talked about. So a much narrower opportunity set, particularly in the US, to drive excess returns, just given the very concentrated nature and very, very higher speculation characteristics that we saw in the marketplace. Those tend to be periods of time when it's more difficult to outperform the benchmark. And we certainly recognize that, but very happy that basically we're in the game on the active long-term growth versus passive. Diversified long-term growth, some of the factors that Keith talked about, particularly from the notion of public markets just being so strong, not quite as strong a participation with diversified long-term growth because we do have 25% of the portfolio that is private. Doesn't react as quickly on the upside to public market turns to see prices go up or values go up. It also doesn't see values come down nearly as quickly as public market values come down. So that is a feature in my mind in terms of having that diversification, helps smooth the ride while hopefully generating excess returns from some of those other factors versus a public only portfolio. And I just talked about that in terms of, so I stole my own thunder. And then looking at the calendar year to date, you can see absolute returns are really pretty solid. Income and growth even generating a number, but maybe well in excess of what we might expect in a normal year with 60% fixed income, but double-digit returns for income and growth. Good solid 15% in change returns for the passive and active long-term growth strategies, and still diversified, but still really very strong 13% return for diversified long-term growth. So overall, we're happy with the structure. As always, we're taking close looks at things that are working a little less well. As with any diversified portfolio, we'll have some components that aren't performing as strongly as we'd like. We're taking strong looks at those to see if there's any adjustments we need to make. But I'm happy to report that for the overall portfolios, we're in pretty good shape in what's been a nice, positive environment for capital market returns. So maybe with that, I will pause and see if we have any additional questions.
Great. Thanks, Travis and Kenny. Do we have any questions from the audience? I'll wait just a second. You just put it in the Q&A box in the bottom of your screen. But if we don't have any, just want to thank Travis, Tim, and Kenny for your insights today. If you do have any follow-up questions, feel free to email me or anyone on my team. Our contact information is right below. Just a reminder, there's a posting of this recording to my FFTC/resources as soon as possible. And thank you, and hope everyone's week goes well. Bye, everyone.
Excellent. Thanks all. Bye-bye.